Hi traders, Nick here. I wanted to answer a question which I'll use as an opportunity to just brush up on a lesson of put butterflies or butterflies in general. Okay, the question came from somebody wants to hedge a portfolio. I'm assuming it's a long portfolio with a bearish put fly, which basically they want to, just in case the market falls, they want to have some greens coming in to offset some losses that they might incur. Okay, so let's start with the put butterfly. Put fly, sometimes they call them put butterfly. It's a leveraged trade. What does that mean? It means I risk a little bit, and if I'm right, then the profit is a lot more. So if I risk 1, I get 10 back. So there is it sounds great, but there are drawbacks. Okay, let's talk about general put flies. Okay, the idea is such: if price is here, this is the SPY. The question was specifically to the SPY. Why? At 245. So this is 245, right? So I buy one put. That costs a lot of money to enter. Okay, that's buying a put. That's bearish. Prices fall, I make a ton of money. Most people want to do a spread. They want to hedge their bet. They don't want to spend $3. I don't know. I'm just speculating. January put. So what I do is I can sell 2. So let's use plus sign for buying, and then I sell. If I sold 1, now I'm in a regular debit put spread. I want price to fall through these 2, and I get maximum gains. What's the maximum gains? I pay, let's say, $3 for opening this one. I collect $1 for opening that one. Maximum price that I paid is the maximum risk, which is $2. The maximum I can make is the width of the spread, and then that's my profit. Now these numbers I'm just shooting out. Don't quote me on that. So the put butterfly changes things. They don't want to risk that much. So what they do is they buy this one, they sell that one just like a regular debit put spread bearish, but they also sell another one of these. So now the entry cost dropped considerably because I only bought 1 and I sold 2. So, but that opens risk. What's the risk? Anything below here. It's risky because I have to carry the losses from this leg. These are capped, maximum loss, but this one, if price falls through 241, these 2 wash out, but now I'm on the hook for 241 on lower. I buy the puts. I have to own the SPY at 241, and if it falls to 0, I'm on the hook for 241 all the way to 0. So what they do is for the put fly, they buy another one here to create balance. Okay, so they have a butterfly of sorts. So they buy 1, they sell 2, then they buy a second one. So now they're imbalanced. They're long 2, short 2 puts. Maximum loss is the money I pay up front. And it's usually pennies, and then return is 10 times as that. So why doesn't everybody do that all the time? Well, the good news is the cost to enter is low, and it's leverage. You can make a lot of money. The bad news is you have to hit it right. This is your maximum profit zone. So if price falls here and stops, perfect. Maximum profits, leverage 10 times, 9 times, 8 times, whatever. Rarely does that happen. If price falls all the way to here, you guessed correctly, but you don't make any money. In fact, you lose some money because it's not good. Once you pass this, you're losing twice, and this, price action doesn't. Sometimes also if it happens fast, the price action doesn't allow you to actually, even if you hit it right here, if it's continuing to fall, they don't give you the prices you want in order to monetize them. So they're kind of tricky. I prefer simplicity. Well, having said that, the question was specific to the SPY and specific to 3 legs, and it's definitely not a regular put spread. What they did is, first of all, it's unbalanced. And let me review it in order to make sure I get it right. Okay, so they did 2 things. 1, they didn't buy a put fly, they sold it. What does that mean? Instead of buying one here, they sold this one. Oops, they sell it, a minus. And instead of selling these 2, they bought. In fact, they didn't buy 2. Let's go with that. They bought 2, okay? And then to make the balance, they sold another one here. So the entry cost to this shenanigan here is a credit, and they kind of change things around by adding another put here. So they do have a butterfly of sorts, but I don't think there's a particular name to that one. Okay, so they sold one open risk, they bought 3, and then they sold another one to create some sort of balance to lower the entry cost. So this is definitely a directional bet, but not like the put fly. It doesn't have needle eye. In fact, I bet you anything, if markets keep falling, they keep accumulating profits because of 3 here. Okay, so yeah, he's losing on this one, or yeah, he's losing on that one, but he has 3 soldiers fighting as markets fall. So yes, the question was, is this a good hedge for my long portfolio? Sure. And I'm making a bet on it. So how do I hedge? I hedge by taking an opposing position that, if fallen, I'm obviously losing money on all of my portfolio, but this particular trade will make me money. So this is where balance comes into question. Is this trade too aggressive, and is it making my portfolio now more negative than positive? If so, then I've just changed my thesis on the whole market. So I have to make sure that the portfolio where this is falling into is still balanced the way my thesis remains. If that person is still bullish and they put too big a hedge, now suddenly they don't realize it, but their portfolio now is bearish against what they believe. So it all depends what they're trying to accomplish by when. This trade was set up for January, so obviously they're worried about through December as to what's going to happen. Particularly, I prefer buying puts or put spreads even if I'm wasting the money, just for simplistic reasons. So even if I sacrifice a crash put, so if I pay a few $100 between every couple of months between now and the end of the year, simple naked puts, and if markets crash, I call them sacrifice puts. If I have a lot of money on the line for being bullish, isn't it worth my while to spend a couple of $100 to protect my money? Of course it is. So even if I know I'm throwing that in the trash, I can sleep well knowing if the markets crash to 0, I'm going to be in the money because I own puts way up here or way down here or wherever. I'm going to stop the bleeding at X. I'm going to do this. So keep it simple, as they say. That's my advice, in my opinion, for me. But this definitely qualifies as a hedge, especially the way they structured it, because if I did this correctly, they are going to be profiting all the way down. There's no limit. But they do have a break-even point where they don't start to profit until a certain point. So just make sure that the way it's done is done correctly. I believe that with 3 in the stomach and 2 sold out here, it's still a debit entry, so there is money to be lost if nothing happens. So just like sacrifice puts, that also sways me to going with a simpler solution than this. But this is a good lesson. Thank you for sharing it.